Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
Hey everyone, welcome to the 15-Minute Financial Feast.
My name is Troy Westendorf.
I forgot what I was saying, Troy. My name is Mark Triplett. Today we're going to be covering the second part of our two-part series, Milestone or Transitional Birthdays. We covered 5 of the 10 transitional or milestone birthdays last time. This time we're going to be covering the second 5 of those 10. So part 2, we're going to be covering milestone or transitional birthdays beginning at age 65, running through age 72. And we're going to talk about what should you know about each milestone birthday and what actions you might want to be prepared to take as you approach these birthdays. So Troy, let's start with number 65.
65.
What's
we
important
are now eligible for Medicare.
Woohoo!
I like it. So we can enroll for Medicare. We have a 7-month kind of window. So we got the month date of your birthday. We have 3 months prior and we have 3 months after. So we can actually get enrolled in Medicare during that window.
So when's your birthday?
My birthday is April 1.
So April Fool.
It's April
It's hard
1,
to
so you
forget
won't
that.
notice, but it's April 1st.
So your birth month is April.
Yes.
And you have 3 months prior.
Yep, so January, February, March.
And 3 months after.
May, June, July.
So that's your 7-month window
Right.
for Medicare. When you turn 65, you got a few years before that.
I got a few years, yep. So once we're enrolled in Medicare, one of the things is we're no longer allowed to contribute to an HSA, just so they know that. You don't necessarily have to turn on your Medicare at 65, but if you do, you can no longer contribute to your HSA.
And if you're currently receiving Social Security benefits when you turn age 65, so let's say you claim Social Security benefits early, when you turn 65, you will automatically be enrolled in Medicare Part A and no longer be eligible to contribute to your HSA. And I know there are folks out there that are planning on continuing to work beyond age 65. They may have benefits through work that allow them to continue to do that, and they're continuing to plan on contributing to their HSA. However, if they claim Social Security prior to age 65, they're claiming Social Security benefits because they decided they wanted to claim early and get while it's good.
Right.
The moment they turn 65, they're automatically going to be enrolled in Part A. Maybe it may not cost them anything, right? Because most folks don't pay anything for Part A, Medicare Part A. But because they're enrolled in Medicare Part A at that point, can't contribute to the HSA anymore, even if they would have been able to otherwise. So another reason to really think through whether you are going to file for Social Security benefits prior to your full retirement age or early.
Hey, one of the questions that comes up quite a bit is that when I hit 65 and I turn on my Medicare, do I have to claim Social Security benefits?
You don't have to. No.
So how does that work if I'm not claiming? How do I pay for my premium?
So if you decide that you want to optimize Social Security for your household and you want to take a delayed strategy, or your full retirement age, for a lot of folks listening, is beyond 65, it's somewhere between 66 and 67. In that case, you can still file and should file for Medicare if you're eligible at that point. But that doesn't mean you have to file for Social Security benefits. It just means you're going to have to pay the premiums out of pocket.
Nice.
Okay? And once you file for Social Security, then you can have those premiums for Medicare taken out of your Social Security benefits if you choose to do so.
Nice. So, now, Mark, we've hit age 66, 67. These are two crucial dates again. So now we're past the 65. We're 66, 67. What are one of the first things that happen when we hit that age?
Well, as I just mentioned, for many of the folks that are listening to this, your full retirement age for Social Security benefits is probably somewhere between 66 and 67. And who knows what the future holds. the Social Security system is going to need some overhaul at some point. If we don't have an overhaul, benefits could potentially be reduced in the future. That is no news to just about anybody. And right now, my 10-year-old, his full retirement age benefit starts at 67.
Yep.
Same as me, same as you.
Yep.
So I highly expect to see full retirement ages kicked out for younger workers. But right now, under current law, at age 66 to 67, most folks listening are going to be transitioning to their full retirement age for Social Security, which means they are now entitled to 100% of their benefit. So for those born between 1943 and 1954, your full retirement age benefit is 66. For those of you born between 1955 and 1959, your full retirement age increased by 2 months every year. And just for example, like if your birth date was 1956, your full retirement age or FRA is going to be 66 and 4 months. And then for your FRA for folks born after 1960 is age 67, and there's no graduation beyond that. So I highly expect younger workers to have some sort of full retirement age benefit that is graduated further out than that, a different age. But that's how it is today.
So one of the other things is for every year you delay claiming Social Security beyond your full retirement age, you receive an 8% delayed credit. So in other words, if your Social Security benefits start, let's just say your full retirement age is 67, you claim at 68, you're entitled to 108% of your full retirement age benefit. Now, we're not going to tell someone whether they should when they should claim without doing any discovery and analysis that we do here, but just shows the impact of claiming early versus delaying when you're talking about that 8% increase.
Absolutely, and that's an 8% increase on their benefit.
Yes.
For the rest of their life.
Right.
And it's an 8% increase on their benefit that would also be eligible to receive any cost of living adjustments when Social Security announces a cost of living adjustment. So delaying beyond your full retirement age can significantly increase the household cash flow, particularly tax advantage and government backed and inflation adjusted cash flow coming to the household. So making a claiming decision on when to file for Social Security benefits without doing a complete comprehensive analysis of how it interacts with all of your other retirement resources and how to optimize it for your household would be ill-advised. Once you've reached full retirement age, there is no longer any earnings limit, which we talked about in a previous discussion, but that earnings limit goes away. When you hit your full retirement age, you can make as much money as you want, claim Social Security, and they don't claw back any of it.
Which is nice.
Right? Yep. So you get your full benefit and you can work and make as much money as you want. That's the good news. The bad news, though, Troy, is that
taxes.
You got to pay taxes, right? If you're making really good income,
right,
that ordinary income gets added to the provisional income calculation,
which can bump you to the next highest tax bracket if you're not careful.
Well, you're gonna have a significant portion of your Social Security benefits subject to tax anyway.
Yeah.
So let's say you're 67, that's your full retirement age. You're making really good income, and you decide that you want to claim Social Security, which you can without having any permanent reduction and any earnings limit being applied. But you're making such good income that now 85% of your Social Security benefit is going to be subject to tax, and you're making such good income that you're pushing into the 22 or 24% tax bracket right now. Your effective tax rate is higher than it would be. It may not make sense to claim right now. You might actually want to take a delayed credits, and if you don't need it, and allow your Social Security benefit to continue to accrue, and then by age 70, perhaps you're no longer working, and now your benefit is much higher, and you didn't necessarily pay unnecessary taxes on those Social Security benefits, or at least at the same amount that you would have if you claimed earlier. So a tax analysis along with a Social Security analysis and a complete retirement income analysis, is advised before making any irrevocable decisions regarding Social Security.
Absolutely.
Now, let's talk about age 70.
Yeah, so age 70. So we're really liking this delayed credit thing of 8%.
Yeah, I like that,
nice.
Right? If my full retirement age is 66 or 67 and I delay beyond that,
we're getting 8%
credit,
bump.
right?
Yeah,
why not?
We're liking it.
So let's keep doing that.
Keep doing it. The problem is at age 70, it's done. So if you're thinking, well, I'm going to go into 72 and keep getting my credits, it stops at 70. So once you hit 70, it gives you no benefit to delay your Social Security.
And in our classes, I always tell a story. There's a gentleman that we ran into. He was 72, and he was so proud of the fact that he hadn't claimed for Social Security, and he was getting these 8% credits. But apparently nobody had told him that at age 70, the delayed credits stopped. So he had now missed out on 2 years of claiming Social Security benefits with no reward for it and no way to claw it back. That's just one of those things, you make a mistake and you can't undo that one. So make sure you know the rules, and age 70 is the last, that's the last year at which you earn those delayed credits. Nobody should be delaying Social Security claiming beyond age 70. You should definitely be claiming your Social Security benefits by age 70. There's no reason to wait beyond that.
So now we've hit 70. 6 months later, we're 70 and a half. There's a lot of fractional numbers here, but we're at 70 and a half now. What happens at 70 and a half?
So at age 70 and a half, you're now eligible to make what are called qualified charitable distributions from your IRAs direct to a charity. Now, this can satisfy your desire to give using forever taxed money like IRAs or other IOUs of the IRS, and also receive a tax deduction and reduce your pre-tax account balances, which may reduce your future required minimum distributions and combined impact of taxes. And I think it's really important to know here that, or at least to note that age 70 and a half used to be the age at which you were required to start taking minimum distributions from your pre-tax accounts. And so age 70 and a half, having qualified charitable distributions made a lot of sense, because if you're going to be forced to take IRA distributions and you don't want to, well, maybe we can just give it to charity, and at that point, kind of offset some of those taxes or get a tax deduction. When the Secure Act was passed and changed the rules with regard to required minimum distributions, this was back in 2019, when that was passed, they did not meddle with the qualified charitable distributions. So even though the RMD age changed, today you can still start qualified charitable distributions from your IRAs at age 70 and a half, even though you're not forced to take required minimum distributions. So from a tax planning perspective, if somebody has a large IRA balance that they're probably not going to be needing throughout their lifetime, they want to give to charity. Maybe they're supporting a church, or maybe they're supporting some other organization that they are that they want to support, whatever it is that they're doing. They can do so in a tax efficient manner if they know how to do it. They can't take the distribution, have it distributed to themselves. It has to go to that charity directly. It's important that you understand the procedures along with that and what to do, and you're working with your tax advisor to be able to track all of this. But it is a milestone age at 70 and a half because of that particular opportunity.
So now we're at 72, and now we are required to, most people have heard this term, required minimum distributions, RMDs, from our traditional pre-tax IRAs, accounts like 401k plans, if we still have dollars in there. We're going to be required to take these distributions. Required a certain amount, and they have a percentage they do each year, and it actually increases each year. But they tell us, here's what we have to take out of those IRAs, 401ks, and now we're forced to pay tax on those dollars.
Yeah, a lot of folks by age 72 have settled into kind of a lifestyle and they have their income sources, maybe Social Security, pension if they're fortunate enough to have one. Maybe they've set up their own income stream by using some sort of guaranteed lifetime income product like an annuity or something like that. So they have their income their cash flow figured out. And then all of a sudden, they're forced to start making distributions from pre-tax accounts that throws in additional taxation on top of what they already have coming in the household. And sometimes this can drive folks into a higher effective tax rate and a higher tax bracket. It can impact Social Security. And a lot of folks don't like it and don't want to take them.
No.
But what happens if you don't take those distributions?
There is a penalty.
How big is that penalty?
Well, the penalty can result in a steep penalty equal to 50% of the RMD itself.
Right. So if you were supposed to take, let's say you're supposed to take a $6,000 required minimum distribution that year, and you didn't do it because you either didn't know, and it is your responsibility. If you're working with a financial advisor, hopefully they're telling you to do this and making sure that they have tracking capabilities to help you do this.
Yes.
But it is technically your responsibility in the eyes of the IRS. If you don't take that $6,000 distribution, they're coming for $3,000 of it as a penalty for failure to take that withdrawal. So it's really important. Most financial institutions today, most financial advisors, if you're working with anyone that's worth their salt, is going to make sure that you know what you need to take and where you need to take it from. But it is your responsibility to make sure at age 72 you're doing that. That is all for this week's show. We've covered those last 5 of the 10 transitional birthdays, or those milestone birthdays. If you have questions about any of the topics or any of the topics we covered today, those birthdays, or any other financial related topics, you can visit our website at www.mypt5.com, www.mypt5.com, and submit it there. Or you can reach out to us directly if you feel comfortable doing that.
Yeah, so, many folks are struggling, Mark, to answer the financial questions, many of which we've just discussed today. And it can be a difficult time. It's not easy. It can be a process. It can be stressful. But, you do have the power to make those meaningful introductions. If that is something that you would like to do, or know someone that's struggling and needs a second opinion, or just needs some help wrapping their arms around this stuff, reach out to our office. Or Mark said you can visit our website. Get in touch with us. Mark and I would love to help you. Just kind of wrap your arms around this. It's something that you just can't do with a pen and paper anymore. We have the tools to do it, and we would love to help you out. Until that time, though, my name's Triplett-Westendorf.
I'm your host, Mark Triplett, serving up bread for the head. Every dollar has a purpose, Troy.
Every dollar has a timeline.
So until next time, be sure that all of you listening are taking steps to retire with purpose
and on time.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.